Coming up today, the losing streak continues. What to expect next? Tesla continues to rip, whilst NVDA and others pull back. Retail sales come in hot, and is Santa Powell coming to town? Let's go, guys. And welcome back, everybody. We're getting more of the same today, pretty much what we've had for the last couple of weeks now. In fact, we got a bit more of a bearish breadth of a day today. Key indices like the Dow Jones Industrial losing their 50-day VWAP, now on its longest losing streak since 1978. And stick with me today because I'll show you some stats of what we can expect next looking back in history. But first, I'll give you the bird's eye view of some key markets, all the trends, and a bunch of blue chip stocks that are currently oversold. We're getting some technically bullish signals firing off. So I want to show you those charts along with some market stats, and then we'll talk a little bit later on about the Fed, who's set to meet tomorrow to decide on interest rates for the last time this year. And so that's a key event for this week. That could also get things moving. But first, let's just look at some charts. Here's the spread chart of the S&P 500 equal weight ETF versus the SPY. We can just see how technically oversold we are here in market breadth. And not just only in large caps either, but in small caps. Just looking at the spread of the Russell versus the SPY. Bit technically oversold here at the moment. And so there's two things causing that. We've got the large mega cap tech stocks continue to push higher here. Apple seeming to walk the line on this really strong run, which is a little surprising considering fundamentally they've pretty much been going sideways in growth for a few years now. Even though the stock price has doubled, they do have a massive buyback program as they have done for years. That's really supportive of the stock price. But just a relenting march for the world's largest stock, now almost on a market cap of 4 trillion. We're now at 3.83. Not all that far behind Microsoft as well, trading really firm here. And of course, the biggest comeback of all the mega caps this year has actually been Tesla, up over 100% just in the last couple of months. Brand new all-time highs, market cap above 1.5 trillion, but we are for sure technically stretched here, overbought. Fourth consecutive reversal signal of mine, just looking back the last time we got them, they did mark some short-term tops in the stock price. So I, for one, wouldn't be adding to my position here in Tesla. If anything, not a bad time to take a few chips off the table in Tesla and maybe recycle them into some other stocks that are currently oversold, which I'll show you in a minute. But we do have a really distinct market setup. We don't have indiscriminate selling across the board, heaps of dispersion out there like I'm about to show you. But we've still got these frothy parts of the market like quantum computing not seeming to want to give up. QUBT up another 51% today on monster volume, 189 million shares traded. Rigetti as well, up 32%. Arquiq Quantum actually breaking out today. And then some of the smaller AI stocks as well. Big Bear AI pushing up again today. And the original meme stock, the one that started it all, GameStop, it too also pushing up to multi-month highs here. And other smaller names as well shaping up, like Tiger Brokers on a bit of a bull flag here. Fend this big push up we had last Monday. And so there's a look at the sector performance for today. It was actually a bit more correlation amongst the sector's performance here. Because just going out to a 5-day chart on this, you'll see the big difference we've had not only over the last week, but over the last month. Huge difference. We've got discretionary up almost 11% in the last month. At the same time, we've got energy down 9%. It's almost a 20% gap over the leading sector and the lagging sector just over the last month. Going out to a 3-month chart again. That was the election there, 5th of November. Really kicked off this dispersion in the market with those big mega cap tech helping these sectors outperform and getting hit hard. Healthcare, materials, REITs and consumer staples. And I'll just show you the daily charts on some of these key sectors, just so you can see how different they look from one another at the moment. There's consumer discretionary. But the thing you got to remember with these funds is they're often quite concentrated. Just looking at consumer discretionary, 23% in Amazon, 21% in Tesla. So almost half the fund is just in 2 stocks. And that's why we look at market breadth to get a much better idea of what's really going on underneath the hood. And as you can see, looking at market breadth, pretty much every sector is very oversold. Only a small percentage of stocks above their 20-day moving averages here in the short term. So that's why the XLY discretionary sector looks like that, because it's really concentrated. Same deal with the communications sector. Still seems to be in a well-defined uptrend here. However, looking underneath the hood, you'll see that is also somewhat concentrated as well. 20% in Meta, another 20% in Alphabet, then Netflix. So again, 40% of the fund just in 2 stocks there. A much more diversified ETF, the retail sector. Pretty surprising of late, considering we've got the threat of tariffs, which could affect many of them that import from China. It holding on to a bit of a bull flag here pretty well. So that's kind of in the middle between the best performing sectors, just as financials is as well. Just lost its 50-day today. And consumer staples, somewhat in the middle. However, really oversold at the moment is some sectors like home builders. Got some reversal signals here. Along with industrials having a bit of a pullback. Transport's oversold as well. And especially oversold energy sector. Currently more than 7% away from its 50-day VWAP. And also very oversold healthcare. Getting some bullish reversal signals here in this key support zone as well. So let's take a look at some large stocks in these sectors that are also giving us these bullish oversold signals. First one, ExxonMobil, very oversold here at the moment. And like I said, oil and gas does have a bunch of bullish seasonality over the next couple of weeks and couple of months as well. So this could be setting up for a pretty good contrarian bounce here, and quite a few names in the commodity complex as well. Not just oil, but also aluminium stock Alcoa, a bit oversold, a lot of bullish seasonality in the next 1-2 weeks and month. Steel as well, STLD, 15% below its 50-day VWAP, and the home builders got some good bullish seasonality here. Just looking at Pulte Group, and Builders First Source could be setting up for a bounce as well. Along with the blue chip, GE Aerospace could be setting up for a bounce. And probably one of the biggest contrarian plays in the market at the moment, United Health. Knocked down again today, 2.6%, but look at this, we've got the entire candle well below the buy-sell band. We don't have much bullish seasonality, however, I'd say this is a bit of a special situation, just looking at what's happened in this stock over the last couple of weeks. And definitely the fundamentals are damage to the stock, looking at the medium long term. However, short term here for a swing trade could be in for at least a little bit of a bounce and some short covering as well. As we are seeing some green shoots across the healthcare sector today, Pfizer putting in a pretty good day, up almost 5%, reclaiming its 50-day, and Johnson & Johnson as well, finishing today higher, trying to find support like it has done at this prior level before. So long story short, we have a bunch of names in the market like Apple, Tesla giving us overbought signals, and another bunch of blue chips giving us oversold signals at the same time, helping to give us these records that I'm about to show you soon. And like I'm about to talk in a minute, Jay Powell and his language tomorrow could set off a reversal in the market. This big divergence we've got happening, once we get a catalyst, that could help it converge. And it's just interesting looking at the performance of healthcare stocks relative to the market, the S&P, coming into the election and coming out of it, very similar pattern to last time Trump won back in 2016. Healthcare stocks were selling off going into it, kept on selling off in the month of November. However, just before December started, they found a little bit of a bottom, traded up, did a bit of a retest, slight little fake out, double bottom, bullish divergence, and then it kind of bounced from there. Here we are in 2024 in the light blue line. We've actually sold off a bit more harder in healthcare stocks compared to 2016, and definitely a bit of a gap there between the performance in 2016 to where we are now, just like we saw a few months back, and that gap actually closed. So if the rest of this month going into 25 is going to play out similar to 2016, we may indeed get that bounce in healthcare stocks. As right now, nothing's really been done to harm their profits. It's more just the perception the new incoming admin is going to do something, along with the recent shooting of the United Healthcare CEO, that's probably exacerbated the move somewhat as well, especially in United Health, which also has significant weighting in the Dow Jones Industrial Index. Because just keep in mind, the Dow Jones Industrial is a price-weighted index. It's not market cap weighted like the S&P 500. So higher price stocks like United have a much bigger weighting compared to other lower price stocks. And there's a look at market breadth today. We can see a bit more red than what we had yesterday. Still getting mega cap tech standing up here, but they're becoming a bit more isolated, apart from a bit of a bounce there in healthcare today. That's why I think maybe United could be setting up for a contrarian bounce as well. So that was a little bit of a defensive move. However, energy stocks still coming off, along with industrials, transports, and financials, and semis still pretty subdued as well. And so on the back of these moves in the market over the last couple of weeks, we're getting some unique patterns and in fact some records. We've just gone 11 straight days of negative breadth, more declining stocks than advancing stocks. That's actually the first time it's happened, whilst the S&P at the same time has actually finished higher. But I guess that just shows you how concentrated the S&P's really become with mega cap tech and those few stocks continuing to trade up to highs. But we can see this sort of pattern when the market's either in panic mode like October 08 or in 9/11, but we can also see it near market peaks. December 99, January 2000, and after the market peaked in March 2000, we got that deteriorating breadth again in June 2000. However, we also got the signal in March 99, about a year before the market topped. So maybe this is a little bit of a warning shot of deteriorating market breadth, suggesting we could be approaching a significant top in the market next year. We're also getting some other records. S&P 500 value stocks have now declined for 12 consecutive days. That's the longest losing streak in history, kind of like a waterfall pattern here. And like the main headline on CNBC today, Dow Jones Industrial on a 9-day losing streak. That's the longest since 1978, almost 50 years since we've seen this. However, it's not all bad news. Just looking back in history, when the Dow's previously gone down 8 days in a row, whilst it's above its long-term 200-day moving average, looking forward a month, it's been higher all bar one time. And in the prior 6 times we've seen this, the market's been higher in 2-3 months' time, every time. And now we're pushing a record of consecutive days of negative breadth, more declining stocks and advancing stocks. On the S&P 500, looking back in history, every time that's happened more than 8 consecutive days. The next month is only a bit better than average. Same with 3 months. However, looking out 6 months and a year, there was only one instance in each time. the market wasn't higher. So not necessarily a bad thing looking out over the next 3-6 months. However, it can indicate a little bit more weakness in the coming weeks or month. But once again, we're getting more unique patterns, stuff we haven't really seen before. This is the first time in history that over 40% of banks were tightening credit standards, and then we went back to not tightening without a recession having occurred. So typically when banks start becoming a lot more conservative on their lending standards, denying more applicants, requiring larger deposits, that's because they see the economy deteriorating, and that just adds on to it because the flow of credit has a huge impact on the economy. So when banks start tightening, that pretty much helps us get a recession, just like it did back in 01 and especially in 08 as well. Briefly in COVID, however, the banks were tightening starting in 2022, going into 23. That's why we're getting a lot of indicators a recession was just around the corner. However, they've gone back to loosening, credit flowing more freely, happy to lend. We didn't get the recession. In addition to the bond yield curve having been inverted for a couple of years, is this time truly different? But we have been seeing some peak sentiment and participation in this market. In addition to those pockets of froth, definitely a sign things could be getting bubbly. Also, just looking at the level of cash holdings amongst investors, falling to 3.9% in December in what's typically a contrarian signal. That is when most investors get fully invested, could be closer to a top than a bottom, and vice versa. When investors raise a lot of cash, we're typically closer to a bottom. However, like all indicators, it's not always the case because investors did have large cash allocations in May 2000, which was actually a good move, especially a good time to buy bonds as well, lock in some high yields before rates get cut. However, at the moment, we're down near record lows. Most investors fully invested, and whilst that may not indicate an immediate top for the here and now, it is something to keep an eye on. Another thing I'll be looking for next year is whether the IPO market can come back. Companies going from private to public, raising capital, still well off the highs from late 20, early 2021. And that's something we typically see at market peaks, is IPOs peak out as well. Because normally in a bubbling market, companies left, right, and center rush to cash in on that. On a hot market when everyone wants to get into the latest craze, we're just not really seeing that at the moment, although we are seeing signs it may have bottomed out. Just like global merger and acquisition activity, maybe still trying to find a base here as well off the 2021 highs. Corporate deal making normally peaks out with market tops as well. Investment banks also cashing in on the craze. But the global market is on solid footing. Looking at a bar chart here, at a universe of 11,000 global equities, how many have increased their dividends in the green? How many have decreased in the blue? So we're going on 8 consecutive quarters of more increases than decreases. And like I said, it's just a bit of a strange market at the moment. We've just got these like isolated pockets absolutely ripping up, like Tesla, Wall Street jumping way back into the stock, analysts left, right, and center increasing their price targets. And it's kind of funny to see this play out time and time again in the market. Tesla comes out with their groundbreaking event and the street's like, I'm not sure, whatever. Then they come out with a good earning and the street's like, okay, that's pretty good. Then the price rips up and now they're all as bullish as ever. Like I said, if anything, now's a good time to maybe take a few little profits on Tesla. I, for one, definitely wouldn't be adding to my long here, as like I said, we're really technically stretched. At the same time, what you could still call the most important stock in the market, still having led this market this year, as this bull market was really kicked off on the back of the AI theme, NVDA. It too also weak and lagging behind, along with the broader semiconductor industry, bar Broadcom, which had ripped up the last couple of days. NVIDIA's just been a little soft, however, it too's given us a bullish reversal signal here today, with a lot of bullish seasonality over the next month or two. And just looking at the entire semiconductor sector, still on a consolidation pattern here with no clear trend. As we've been noting of late, the consumer is still out there spending. Retail sales came in higher than projected in November. Looks like we're in for a pretty good holiday spending season, especially online. Headline print came in 3.8% on an annual basis. There's been strength in car sales. And once again, one of the best performers this year, Walmart. Absolutely stellar return. Still sitting near highs. Amazon as well, just sitting a couple of points below all-time highs. But the big event this week is Santa Powell going to bring us presents tomorrow? Is he going to give us an indication on the Fed's path going forward? Or is he still swing trading this thing month to month? Will the Fed keep cutting rates in 2025? What is the normal rate? Could he really upset markets and go on hold tomorrow? Which would be a doozy if he did. Markets still overwhelmingly expecting him to cut tomorrow. However, he may start hinting he's ready to go on pause. After doing one of the most dovish cuts we've ever seen just a couple of months ago in September, we're already talking about him going on pause. Because like I said back then, the data didn't really support a massive cut. He may have got a little ahead of his skis, may have actually helped reignite animal spirits. Bond yields pretty much just moved up ever since he cut. Surprised a lot of people. And once again, a very different pattern in the bond market that we normally get after the Fed starts cutting rates. Because going into this meeting tomorrow, interest rate traders pricing at 97% odds he will cut. However, They're also pricing him to stay on hold in January, give us another cut in March, and maybe another cut or two in September or December next year. But we'd really have to see CPI inflation, core inflation, go down to a 2 handle. Generally speaking, you want to keep the overnight rate a full percent or two above inflation. You want the cost of capital to be greater than inflation to keep a lid on inflation. And right now, that margin's starting to wane, especially when we've got measures of inflation quickly climbing back up, like the Trueflation Index, currently tracking at an annualized rate of 3%. So surely all the data that's gone into Trueflation is also the same data the Fed and their army of PhD data scientists is looking at, right? And did all this truly catch Jay Powell by surprise ever since he cut? And is that small probability he could stay on hold tomorrow the reason why the VIX got a little bit of a bump up here today after it had been subdued? And even though the S&P 500 hasn't really pulled back that much, which this index pricing is based on, pretty healthy volatility risk premium as well. Option dealers 9.2 points above realized. However, looking at the VIX one day, 13.2 isn't a massive reading. So all in all, option dealers aren't expecting too much fireworks tomorrow. We should get the cut. More importantly, is how hawkish Jay gets in his language on the pace of future cuts. And if he were to come out a bit more hawkish than expected, typically that affects assets more sensitive to interest rates, like mega cap tech, could actually give us a big reversal, along with a bump up in those defensives that have been sold off. That could be the catalyst, or if the market really doesn't like it, we may get a full red day, everything getting sold off. And just looking across the commodity complex, agricultural commodities, still in a pretty strong upturn trend here. Gold still bumping around, along with crude oil, don't have much direction in these large commodities. Uranium a little oversold here, but kind of like the stock market as well, we've got some commodities absolutely ripping. There's cocoa, along with coffee, still on a pretty strong uptrend as well. And the market's measures of inflation kind of just consolidating somewhat. There's commodities versus treasuries, and the 2-year going into tomorrow, 424. We'll see how the bond market reacts after we hear from Jay Powell tomorrow. But like I said, the major themes in the market, there's these big divergences going on in the sectors, and pretty weak, persistent market breadth here in the short term, hitting those records, even though the S&P 500 is still holding up. And we can see that in this chart here, just calling up somewhat, giving us a bit of a bearish divergence on my S&P oscillator here. But just goes to show you how concentrated the index is. Pretty much been flatlining, just off highs by a bit. But then we've got a lot of other stocks and sectors and breadth having really been sold off hard this last couple of weeks. And so we'll just have to wait to see if Santa Powell brings us all a Christmas present tomorrow. Otherwise, that's a wrap for the daily market review today. Thanks very much for tuning in, and I look forward to breaking it all down for you again this time tomorrow. Cheers.